Hi, and welcome to today's webinar on financial information about selling your home. My name is John, and together with my wonderful colleague Renata, we will be your hosts for today. Our aim is to guide you through this webinar and provide you with important information that you need to know about selling your home. Before we begin, I'd like to acknowledge the traditional custodians of the lands we live on today, and extend Services Australia's respect to all elders, past and present, of all Aboriginal and Torres Strait Islander nations. I'm speaking to you from Wiradjuri country in the central west of New South Wales, which has been my home for over 40 years. Now, for a little bit of housekeeping. If you're attending our webinar as a live event, there is a question and answer feature you can access to ask questions while the webinar is in progress. Near the top right hand of the screen, you'll see an icon that looks like a speech bubble with a question mark in it. Use this to ask questions along the way. To protect your privacy, please only use your first name or tick the box to send your question anonymously. Our team of moderators are on hand to answer your questions, and if they think your question would be useful for others to see, they may publish it. Otherwise, we'll just reply to you. And for those watching on YouTube after the event, you can find the links shared during the live event in the webinar summary section. Today's information is brought to you by the Financial Information Service, or FIS for short. As FIS officers, we talk to people like yourself about all things financial, helping you understand your options so you can make informed decisions. Some of these decisions can impact your pensions, so the information we provide can help you understand this. We're here to support you and answer your questions. However, it is important to clarify that we are not a financial advisory service. We don't provide financial advice or tell you what to do with your money. Instead, we offer free, confidential and impartial information to help you take control of your finances with confidence, so you can make the choices that best suit your circumstances. Today, we'll cover some of the key features to consider when selling your home. You can expect to hear about selling your home and accommodation options, the differences between retirement and lifestyle villages and services they may provide, your entitlements to rent assistance and if you may be eligible, the Home Equity Access Scheme, where you can use the equity in a home you own to increase your pension, our online services and how you can use this service to make claims, update information, plus more. There's a lot of valuable information ahead, and you may come across things you'd like to discuss with a FIS officer. So it's a good idea to have a pen and paper ready to write down any key information or questions you may wish to ask or follow up after the event. Before we dive in, a quick reminder that today's presentation provides general information only. Everyone's circumstances are different, so you may need to speak with us on an individual basis for information specific to your situation. The information in this webinar is current as of today, the 7th of May 2026. Please note that payments, rates and thresholds do change over time. So for the most up-to-date details, we recommend you visit our website for further information. As you can see from the current slide, there is a variety of housing options available, and the best choice depends on your personal circumstances. For some people, a decision to remain in their home may no longer be an option due to health reasons, and they may need to transition into aged care. Where for others, they may choose to borrow against their property through a reverse mortgage or the Home Equity Access Scheme to unlock some of their equity to update their current home. They may even choose to downsize to something smaller or move in with family to suit their current and future needs. Whatever your choice is, there will be advantages and disadvantages. Different rules may apply, which could impact on your Centrelink entitlements. We will cover more details on these options throughout the presentation. If you currently have an established home, then you may wish to stay there. However, there may be some issues that you need to consider. Does your existing home meet your current and future mobility issues? You may be able to access services for care in your home, meaning you can remain there. Are you able to maintain the home and garden? Or is it appropriate to hire a gardener or handyman for small repairs now or in the future? Can you afford paying for renovations to repair the home, which may be more beneficial than selling and moving to another home? If you need financial assistance and own your home, you can consider products like a reverse mortgage or the government's Home Equity Access Scheme. Costs can play a significant part in a decision where you may choose to relocate. They can include agents' fees, transfer or stamp duty, removals costs, and brokerage fees. Then there is the social aspect. Where you currently live or where you may plan to relocate to may be closer to family and friends, community activities, transport and clubs. By being closer to family and different services, the support available could play a huge part in your decision, especially as you get older. A benefit of relocating could include downsizing your property, which could free up money to pay off your mortgage or have some additional funds left over to invest or spend. A smaller place can take less effort to clean and maintain. It can also cost less to insure and may be cheaper to heat and cool. Choosing to sell your family home can be a difficult decision, as it may be full of memories and is considered one of the leading causes of stress. So if you're having trouble deciding where to live and if it's the right move, you can try renting in a new location before making a decision. Once your home has sold and the funds have been dispersed, you need to provide information to Centrelink within 14 days of settlement. Depending on your circumstances, we will look to apply the sale of home provisions to income support payment recipients. This relates to anyone who sells their principal home and intends to purchase, build, rebuild, repair, or renovate what will be their new principal home. Generally, the date of the sale will be the property settlement date, as this is when the funds and title are exchanged. The portion of the proceeds from the sale of the former home that the customer intends to spend on their new principal home are asset test exempt for up to 24 months from the date the home was sold, with an extension of up to 36 months total in some circumstances. The funds from the sale intended to be used for the purchase of the new home are exempt from the asset and deemed at the lower deeming rate, currently 1.25%. You will continue to be assessed as a homeowner during this period. Please note, the exemption does not apply if customers have moved into their new home and then intend to undertake the renovations. Another important note is that funds from the sale not intended for the purchase of the new home are not exempt and are subject to the normal deeming provisions and are assessed under normal asset testing rules. The asset test exemption may be extended from 24 months to 36 months. To receive the extended period, you must have made reasonable attempts to obtain a new principal home, made those attempts within a reasonable period after selling the principal home, and experienced delays beyond your control in obtaining a new principal home. These points I have just mentioned must be met and evidence needs to be provided to satisfy the criteria. Where the asset value is exempt during the extended period, the funds continue to be deemed at the lower deeming rate only. Customers continue to be assessed as homeowners during the extended exemption period. For further information, please contact our FIS team. An alternative to owning or renting are retirement and lifestyle villages. Retirement villages and lifestyle villages may look the same, but they are different types of accommodation for seniors. There are different laws for each type, and these laws vary from state to state. Both have age restrictions of having to be over 55 or at least 50 years of age. They may offer self-contained or service units, and you may be able to get rent assistance depending on your circumstances. It is important to check with the operator or salesperson to see what type of accommodation it is, what is on offer, and which laws will cover you as a resident. When considering a retirement village, you need to ensure that you review and understand your contract. These contracts are a right of occupancy and services, rather than ownership of title. It is important to understand the terms and conditions and fees and charges. Each state has their own Retirement Villages Act, so ensure that you get independent legal advice before signing a contract. The retirement village determines the amount of entry contribution you need to pay, and most retirement villages will require some form of ongoing fees on top of your initial payment. These can also include one-off or ongoing fees even after you have left. Some of the benefits of a retirement village can be that you are around people of the same age group, you have no upkeep or maintenance responsibilities, and you have security. Some things to consider could be the maintenance and ongoing fees. There's no capital returned until the unit is sold, and sometimes that can take some time to sell. The current table displays an amount of $258,000, which is known as the extra allowable amount. This is the difference between the homeowner and non-homeowner asset limits, and is indexed each year. Based on the amount you pay for your entry contribution into a retirement village, a decision will be made on how we treat your homeowner status and if rent assistance is payable. As you can see from the table, amounts paid over $258,000, customers are treated as homeowners where no rent is payable, even where you may have ongoing costs, such as maintenance fees. Where you have paid $258,000 or less, the lump sum will be treated as an assessable asset, but it is not subject to the deeming provisions. In this case, you may also be eligible for rent assistance. In lifestyle villages, you own your building and pay for the use of the land. Names used by these facilities can include lifestyle villages, park homes, mobile park homes, over 50s villages, and these are covered by the residential park laws, which is state-based. It is essential to clarify what state legislation covers the facility. Because you are not purchasing the land, you may be able to save on stamp duty. However, as you pay for the use of the land, you may have site fees or a rent amount, which you need to contribute as part of these conditions. In this situation, you may be able to apply for rent assistance if you receive a payment from Centrelink. It is important to understand what you are signing up for. So before you sign the documents Always seek independent legal advice. You can also contact our FIS team to ask questions. When a customer takes up residence in a lifestyle village, they are for Centrelink purposes considered to be a homeowner. The entry contribution amount paid to the lifestyle village is not applicable. In these cases, the value you paid for your home is an exempt asset. In most cases, you will be paying an amount of rent or site fees, and depending on the amount you pay, you may be able to claim rent assistance. Rent assistance is a supplementary payment that is made to eligible customers that receive a Centrelink income support payment, which include ab-study and family tax benefit. The amount of rent paid for your primary residence must exceed the set thresholds to entitle you to part or all of the rent assistance. If the amount is below these thresholds, then no rent assistance is payable. To be eligible for rent assistance, a customer must pay rent for their primary residence in the form of the following: private rent. In a retirement village, if you are assessed as a non-homeowner, you may get rent assistance. We base the assistance on your ongoing fees. In a lifestyle or over 50s village, you will usually be eligible for rent assistance. Site fees are an amount you pay to the owner of land holding, like a caravan park if your principal home is a caravan or transportable home. If your principal home is a boat, you may be able to claim rent assistance for the mooring fees, which are the amount you pay to keep your boat moored. If you're a homeowner and you're travelling in mobile accommodation for 12 months or more, you may get rent assistance if both these apply, that we assess your principal home as an asset and you're paying for site fees for your mobile accommodation while you travel. Boarding and lodgings is when you pay for accommodation in either a private home or other shared accommodation, which includes meals. Lodgings only is when you rent a room and it's either in private home or shared accommodation. You usually share common areas like a kitchen, bathroom or laundry and provide your own meals. In some cases, you may pay rent or fees but may not be entitled to rent assistance. We will look at some of those cases now. Where you pay rent to live in or lease a house from the state or territory housing authority. You won't get rent assistance if you're travelling away from the home you own for up to 12 months and you own or are buying the home you live in. If you're living in government housing, the Australian government pays a subsidy to the approved residential aged care facility where you live. Your partner gets rent assistance with family tax benefit. You get an allowance and your partner gets rent assistance with their pension. Or where you reside in aged care facilities, which is being subsidised by the government. When applying for rent assistance with your income support payment, you must provide evidence of your rental payment. This can be in the way of providing your formal agreement, which can include, but is not limited to, your lease or tenancy agreement. These generally include amounts, frequencies, and the term of the agreement. In addition, Centrelink can supply you with a rent certificate form to complete, which needs to be signed by both you and your landlord. This form is generally used in cases where you may change address, are a boarder and lodger, or when claiming site fees and no formal agreement can be provided. A landlord is considered someone you are paying for the right to occupy the use of the property. It can cover a range of potential options where they could be the owner of the property, where you have a formal agreement through a real estate agent who is managing the property, or you have the arrangement with an owner directly. It could be that you pay site fees at a caravan park or live at a lifestyle village. Whichever is your situation, you'll be able to provide the appropriate evidence to enable you to apply for rent assistance at that time. There is a range of circumstances and rules that may impact the amount of rent assistance you may be entitled to. It is always best to visit our website for the latest rules and information. Rent assistance is determined by a number of things, which can include the amount of rent you pay, and if you're single, a sharer or partnered. The payment you receive could also determine if you may be entitled to a higher rate of rent assistance. There are lower and higher threshold amounts which determine your eligibility for rent assistance and the amount you may receive. If you do not meet the lower threshold, then no rent assistance is payable. If you pay more than the lower limit and less than the higher limit, then you may get part of the rent assistance available to you. And if you pay more than the higher limit, you may receive the maximum rate of rent assistance. It's always best to contact the FIS team for more information on rent assistance, or visit our website where you can find the latest up-to-date information. This concludes my time, and I will now pass you over to Renata, who will take you through the second half of the presentation. Thank you, and please continue to ask questions in the chat.
Thank you, John. This part of the segment, we'll talk about granny flat interests. Granny flat interests for Centrelink purposes is when you give money or assets in exchange for the right to live in someone else's property for the rest of your life. Despite the name, it doesn't mean that it has to be an actual granny flat. It could simply be a room or a separate area within a home. There are a few common situations where Centrelink will generally accept that no gifting or deprivation has occurred, such as when you transfer ownership of your home to someone else, contribute money to buy a property in another person's name, or pay for the building or renovating part of their home. In any of these arrangements, you cannot be listed on the title as a legal owner of the property. If you pay extra money on top of these three scenarios or pay to live in an existing property, Centrelink may apply what is called a reasonableness test, which looks at your age and life expectancy to decide whether the amount you've paid is reasonable. Generally, younger people can pay more and older people pay less. While Services Australia doesn't require a formal agreement, it is strongly recommended that you get legal advice and consider putting a written agreement in place to protect everyone involved. It's also important to think ahead about what might happen if circumstances change, such as the property being sold, disagreements, or changes in family relationships. You may also want to review and update your will to ensure it reflects the new living arrangement. So if you're thinking of setting up a granny flat interest, it is important to consider if this is a suitable option for you. This type of living arrangement can allow you to access the capital in your home to cover healthcare needs, create a financial buffer, and reduce the responsibility of managing the rates and ongoing upkeep of a property on your own. Other advantages may include lifestyle and social aspects. Living with or closer to family can provide greater day-to-day support, companionship, and a sense of security, which become increasingly important as care needs change over time. A granny flat arrangement may also be exempt from the capital gains tax, provided the arrangement is in writing, indicates an intention that the parties are legally bound, and not be commercial in nature. You can check the ATO website for more details about the exemption. You may also want to consider the drawbacks of this type of living arrangement. As you are not the legal owner of the property, you don't have the benefit of the pensioner concession card discount associated with the property. If you leave the living arrangement within the first 5 years, Centrelink may apply gifting rules. This means the amount you contributed could still continue to count as a financial asset from the date you leave until the 5th anniversary of when the granny flat arrangement started. There is no deprivation if you leave after 5 years or if you must leave due to unforeseen circumstances, such as a sudden illness, a relationship breakdown, if you are at risk of elder abuse, or if the home becomes uninhabitable. The amount you contribute to create the granny flat interest will determine your home ownership status for pension purposes, if that contribution may be exempt from the asset test, and if some rent assistance is payable. So let's break this down for you. If your contribution or amount paid to establish the granny flat interest is equal to or less than the extra allowable amount of $258,000, John mentioned this all earlier, then the non-homeowner asset limits will apply when working out how much we can pay you. Your contribution will be included as an assessable asset, and if you pay rent, you may also be able to get, you might be able to test your eligibility for some rent assistance. However, if the amount you've paid for the granny flat interest is over $258,000, then the homeowner asset limits apply, and the amount you contributed is an exempt asset. Rent assistance is not payable in these circumstances. If the granny flat interest is not for you and you currently own your own home, there are other options you can consider, such as using the equity in your home. Equity is the value of your home less any money you owe on it. There are several types of equity release options. You may have the capacity to redraw on your existing mortgage or line of credit. You just need to weigh up if you can afford the repayments on the loan. There is also a reverse mortgage option, which enables older people to borrow using the equity in their home. Usually you don't need to make repayments on this type of loan. And the third type of equity release option is called a home reversion scheme. This scheme enables you to sell a portion of your home while continuing to live there. The amount of money you can get when using equity in your home will depend on your age, the value of your home, and the type of equity release you choose. Your decision could affect your partner, family, and anyone you live with, so take your time and to talk it through and get independent advice from a financial or legal professional. So let's look at each equity release option in more detail, starting with reverse mortgages. You need to be at least 60 years or older to access a reverse mortgage, and it's a way to convert equity in your home into either a lump sum, a line of credit, a series of regular income payments, or a combination of all of these. Whether you can do this depends on the lender, your age, and the maximum loan amount. If you take a lump sum, interest accrues on the balance withdrawn. And alternatively, if you take a line of credit or an income stream, interest is charged only on the balance withdrawn. Reverse mortgages are secured by a registered interest over your property. The loan balance increases as fees and interest compound, so your debt will grow over time. These loans have a minimum amount you can borrow, typically about $10,000. However, the older you are, the greater the percentage you can borrow due to the shorter time frame of the loan. For example, if you are age 60, The most you can borrow is likely to be 15 to 20% of the value of your home and up to 45% at age 90. A key feature is that the loan, including the interest, is not repayable until you move out of your home or pass away. You now also have no negative equity protection on any reverse mortgage taken out after the 18th of September 2012. This means you cannot end up owing the lender more than your home is worth. Most lenders will require applicants to seek professional and legal advice. The lender will also expect you to have adequate building insurance cover, as well as keeping up with regular maintenance and upkeep to help protect the value of your property. Home sale proceeds sharing is a form of a home reversion scheme that enables you to sell a portion of your home, usually at a discounted price. For example, suppose your home is currently worth $500,000 and you sell a 20% share. Depending on your age, the provider may offer you between $37,000 to $78,000 to buy that share today. Say in 20 years' time, you sell your home for $800,000. The provider gets 20% of the sale price, that is $160,000. Home reversion costs you the difference between what you sell it for now and what it's worth in the future. Also, keep in mind these home reversion schemes are not available in all states. Similarly, equity release agreements also enable you to sell a portion of the value of your home to investors through a property investment fund. It can be paid as a lump sum or by instalments. All maintenance, repairs and insurance costs are shared between the owner and the investors. You pay fees for the portion you've sold, a bit like paying rent on it, and these fees can slowly take more of your home's value over time. With the equity release, when the equity release agreement ends and your home is sold, the funds get their share of the proceeds. You and your deceased estate gets the remainder of the proceeds, if any. These types of products do not have a no negative equity restriction, so it's important to check your agreement to see what happens if your equity goes down to zero. Make sure you can continue living in your home until sold by you or your estate. When it comes to estate planning, there could be implications for the beneficiaries, as they may need to sell the home to pay out the debt. They'll receive less from the estate. And also, because we cannot predict future trends, there could be a potential for higher interest rates and low property market growth. So this will change the result for any beneficiaries. So when considering using the equity in your home, it is important to look at the features and risk of each product and consider if an alternative such as downsizing will be a more suitable option for you. And as mentioned earlier, seek professional advice. Some advantages to accessing equity in your home would mean that you could continue to stay in your home if it suited you, especially if you're already living close to family and medical services. But you also have the advantage of increasing your income by unlocking the equity without having to sell, meaning there'd be no settlement costs or the need to make repayments. A small amount of money each year could supplement your regular income in retirement, or a lump sum may fund renovations on your home so you can stay in it longer. Equity loans can also be used to free up money for urgent medical needs, or it may help secure aged care accommodation until you sell your home. Some disadvantages to consider include the decreased equity in your home, as your debt will grow over time because of interest and fees that compound, and this can add considerably to the overall loan balance. The variable interest rate can be higher than a standard home loan. And in some cases, it could also affect your age pension and how much you can be paid if you have reinvested the lump sum. Home Equity Access Scheme is another type of scheme that allows you to borrow a non-taxable loan from Services Australia to supplement your retirement income. This scheme is available to Australians who are pension age or older and enables you to borrow up to 1.5 times the maximum rate of pension. If you already receive a Centrelink pension, this means that you can increase your total fortnightly payment of pension and loan up to 150% of your maximum rate payable. To be eligible, you and your partner must own real estate in Australia. The building must have adequate and appropriate insurance, and you must not be bankrupt or subject to a personal insolvency agreement. You can choose a fortnightly payment, a lump sum advance, or a combination of both. However, there are limits on how much you can borrow periodically, and there are limits on the overall maximum loan amount. Interest is charged on the balance of the loan fortnightly. Currently, this is 3.95%, and you also cover the legal cost of the caveat charges. You don't need to repay the loan until you sell the property, otherwise it will get repaid from you or your partner's estate. But you can make voluntary repayments at any time if you are able or choose to do so. If you're not eligible for a Centrelink pension under the income and assets tests, you can still apply for the Home Equity Access Scheme, but remember there are several different equity release options to choose from, so please consider your current and future financial situation, the impact of compound interest on the loan and repayment of the loan. Discuss your situation with your family, and if you need help making that decision, seek professional advice. Before choosing to apply for the Home Equity Access Scheme, consider the alternatives such as applying for government payments in your own right if you don't already receive one. And if you are already receiving government payments, you may be eligible for a higher rate if your income and assets on our records are out of date. If you only need a small loan, then consider other options like no interest loan schemes. They're usually available to help with items such as essential goods or car repairs. And lastly, think about if selling your home and downsizing may be a more suitable alternative, considering the costs of selling and buying. Did you know that 1 in 3 Australians find dealing with money stressful and overwhelming? Every day we all make dozens of decisions about money, so making informed decisions leads to greater financial well-being. This is where Money Smart comes in. Money Smart is a federal government website brought to you by the Australian Securities and Investment Commission, also known as ASIC. They offer guidance on anything to do with money and have free tools, tips and calculators to help people of all ages, backgrounds and incomes to be in control of their financial lives. Our self-service is a way that many people choose to manage their information. You can manage most of your Centrelink, Medicare and child support details online or by phone self-service. A MyGov account lets you link and access a range of federal government services with the one username and password instead of logging into each individual app. If you require assistance with accessing, creating or linking services to your MyGov account, you can find out more information at my.gov.au by selecting the Help link in the top right-hand corner, or calling the MyGov Help Desk on 132 307 and select option 1. The benefits of using our digital services means you're first in line every time and you don't have to wait on a phone call or wait to see a staff member in the office. Using the self-service option is a way you can choose to complete your business with us quicker and easier, and this will allow us to continue to provide support for people with special and complex needs. A MyGov digital assistant is now available for customers who need help using MyGov. You'll find the digital assistant in a black rectangle-shaped box on the right-hand side of the MyGov page. This is available to use any time of the day or night from a desktop or mobile device. If you need help dealing with Centrelink, you can choose a person or an organisation you trust to act for you. We call this person or organisation your nominee. There are two main types of nominees. A correspondence nominee is someone who can receive your Centrelink letters, keep track of your information and help you stay up to date, but they can't make decisions or manage your money. A payment nominee has more responsibility. They can receive your Centrelink payments and use the money to pay for your needs like bills or everyday expenses. You can choose to have one or both types depending on how much help you need. You can also choose someone to just make inquiries on your behalf or give them permission to make updates on your behalf. It's important to pick someone you trust because they are expected to act in your best interests and keep your information safe and up to date. You can also change or cancel a nominee at any time if your situation changes. You can find various online help guides and video demonstrations to help you make the most of your online accounts. These include step-by-step instructions for many common self-service transactions you can do in your online account, such as how to create a MyGov account and link services to MyGov, update your contact details, report employment income, and update your income and assets, for example. As mentioned earlier, Financial Information Service can help you make informed financial decisions on any of the topics we've discussed today, as well as help you understand other financial concepts, including Social Security, tax, and superannuation. We can also help you prepare for retirement even while you're still working. We aim to help you take control of your finances to increase your lifestyle choices. To contact us, you can call the number on the screen or any Centrelink number and say Financial Information Service when asked why you are calling. We also offer video chat appointments, which can sometimes be arranged after business hours. You will need to have an active MyGov account set up and have linked Centrelink so you can receive your secure messaging and link to the video appointment. And if your situation is complex, we can arrange a face-to-face appointment at your nearest service centre. We also have other services available to assist you, including an Indigenous call centre line on 1800 136 380. We also have a multilingual phone service line if you need to speak to us in your language on 131 202. And social workers are also available over the phone to assist with short-term counselling, support and information on 132 850, along with several other specialised services. If you don't have time to write these numbers down, you can rewatch this webinar to get these numbers or visit our website. This brings us to the end of the series, and on behalf of John, myself and Services Australia, we thank you for joining us today.